Welcome to video 1C. In this video, we're going to calculate a whole bunch of different taxes. So you ought to get your calculator handy, and you probably ought to have your table pack handy as we work through this video. Okay, let's get started. To calculate a tax, you need to know two things. The first is the tax rate, and the second is the tax base. So the tax rate is the level of taxes imposed on a base. We usually think about that as a percentage, but it doesn't have to be. And the base defines what is actually being taxed and is usually expressed in monetary terms, but again, not always. So tax equals tax base times tax rate. All right, for this next part, you may want to get your table pack handy. You may want to get your calculator handy. And you should definitely practice along as I do these so that you can get the hang of it. So SpongeBob is a single taxpayer. He has taxable income of $75,000 in 2019. And we need to determine what is SpongeBob's U.S. federal income tax. I'm going to encourage you to pause the video right now, go to your table pack, find the right table, and calculate SpongeBob's tax. Okay, this should have been the table you found in your table pack. This is for unmarried individuals for the year 2019. And if we're going to calculate SpongeBob's tax, we would start with, okay, SpongeBob's taxable income is $75,000. That puts him between $39,475, but not over $84,200. And in order to calculate his tax, we have to calculate the excess of his income. So $75,000 over $39,475, that's $35,525. We multiply that by 22%. That yields $78,550. To that, we then add $45,043 to get SpongeBob's tax as $12,358.50.
Learn it, know it, live it.
All right, now SpongeBob has a friend named Patrick. And Patrick has taxable income of $65,000. And he also earns $10,000 of interest on tax-exempt municipal bonds. And we now need to calculate Patrick's income tax for 2019. So we'd go to the exact same table, except now our starting point is taxable income of $65,000. Again, we back out the $39,475 because that's the bracket we're in. That's $25,525, which we multiply by 22%. We get $56,1550. To that we add $45,043 for a total tax of $10,158.50. Now, something that's missing from this calculation is, of course, Patrick has $10,000 of tax-exempt income, which means $10,000 is multiplied by a 0% tax rate. Now, we don't show that because, of course, anything multiplied by 0 is 0. Okay, so SpongeBob and Patrick get together and they want to compare average tax rates. So first, for SpongeBob, we've already calculated his tax liability is $12,358.50. Now we divide that by SpongeBob's taxable income of $75,000 and we get 16.48%. We do the exact same thing for Patrick. We've already calculated his tax liability. We divide that by $65,000 and we get 15.63%. And you can see that Patrick claims he has a lower average tax than SpongeBob. And we probably could have expected that because we know that part of Patrick's income is taxed at 0%, whereas none of SpongeBob's income is tax exempt. All right, so SpongeBob decides that he likes this. He likes this average tax rate being lower, and he wants a piece of some of that tax exempt income. Now, of course, to do that, he's got to sell some of his investment in taxable bonds, and he buys municipal bonds instead. And we're just going to assume that there's no taxable gain on the sale just to make life easy. So now his taxable income is going to be $60,000, and he earns $10,000 in exempt interest. What is SpongeBob's average tax rate? So new SpongeBob looks a little bit like this. His taxable income is $60,000. He's in the same bracket as he was before. We push it through the machine. We get total tax of $9,058.50 for an average tax rate of 15.09%. He now compares that to old SpongeBob, whose average tax rate was 16.48%, and he says, hey, I'm definitely better. Look, I did some great tax planning. The question is SpongeBob better or worse off? Now note that one of the things that happened is SpongeBob's income went down as a result of substituting tax-exempt income for taxable income. Old SpongeBob had $75,000 and paid taxes of $12,358.50. New SpongeBob has $60,000 of taxable income, another $10,000 of tax-exempt income, but paid taxes of only $9,058.50. He ends up with after-tax flows of $60,941.50. And you can see that one of the faults, one of the problems that SpongeBob relied on in his tax planning strategy was to use average tax rate as his measure of good or bad, when in fact it is after-tax cash flows is what really matter.
Learn it. Know it. Live it.
Okay, another thing we just identified in these simple calculations is this relationship that says pre-tax minus tax equals after-tax. And we are going to exploit this formula later on in lots of different calculations. So,
learn it. Know it. Live it.
Okay. Is there a way we can measure the slice of the pie being taken from SpongeBob and Patrick? And we call that their effective tax rate. And the effective tax rate is tax divided by total income. Okay, so SpongeBob and Patrick are both looking at a possible investment that will generate 1% of additional taxable income. Or sorry, not 1%, but $1 of additional taxable income. So we need to figure out how much better off will SpongeBob be and how much better off would Patrick be. And let's worry about old SpongeBob and not get mixed up in new SpongeBob here. Okay, so if we start with old SpongeBob, we've already calculated his tax liability. It's the $75,000 of taxable income. We end up with $12,358.50. Now, new SpongeBob has this additional $1 of income. If we put that additional $1 of income through the machine, we'd see that SpongeBob's tax is now $12,358.72. What's happened is SpongeBob's tax has gone up by 22 cents. That actually makes a ton of sense because that is the marginal tax rate, right? That is the bracket in which SpongeBob is sitting. So to some extent, we could say, hey, your marginal tax rate for an individual is simply the bracket that they're inside of. Okay, what if instead SpongeBob's investment would provide an additional $100,000 of taxable income? Okay, we've got old SpongeBob on the left again. There's our getting used to it, $75,000 and $12,358.50 in taxes. New SpongeBob now has $175,000 of income. We would need to push that up into a different bracket. So that would be $175,000 minus the $167.25. That yields $14,275. That's now multiplied, if you go look at your table pack, at 32%. 32% of that amount is $45.68. We add those two numbers together, we get $37,316.50. Okay, so his taxes increase $24,958 or 24.96%. Why doesn't that agree to the 32% rate in SpongeBob's bracket? Well, the reason is if we pull up the single tax table, we'll see that because of the large increase in SpongeBob's taxable income of $100,000, he's creeping from that original tax bracket that capped out at about $84,000, and he's pushing up into the next tax bracket and into the one after that as well. So really, SpongeBob's tax, that incremental amount, isn't just taxed at 32, and it's not just taxed at 22, it's taxed at a weighted average between all those three tax brackets. Okay, back to our original plan. And SpongeBob has taxable income of 75. Patrick has the taxable income of 65 and 10,000 on municipal bonds. Let's assume that SpongeBob and Patrick are married. What is their income tax? In case you haven't gathered it, there are different tables for individuals. Married individuals use the married tax table. So now their taxable income is the 75 plus the 65, or 140. 140 minus the 78,950, because they would look at the married table, multiplied by 22%, yields a total tax of 22,517. If we were to calculate their tax as single individuals, we would calculate that as 12,358.50 plus 101,5850. That's largely the exact same amount. So you can see there is no marriage penalty at this point. But what if SpongeBob and Patrick are married, but SpongeBob only makes $1,000 and Patrick makes $139,000? SpongeBob's tax is 10%, or $100. Patrick's would increase up to $27,534.50. Their total as a single taxpayer is $27,634.50. But as married taxpayers, it's actually a little bit lower, $22,517. So the marriage penalty is largely gone until income gets very, very high, basically above $600,000. Okay, quick review. The marginal tax rate is the tax rate that applies to the next additional increment of a taxpayer's taxable income. And the book describes that as the change in tax over the change in taxable income. And that worked in our original SpongeBob when it was only $1, because the change in tax was 22 cents over $1, or 22%. The average tax rate is the taxpayer's average level of tax on each dollar of taxable income. You could describe that as the tax divided by taxable income. The effective tax rate is the average rate of taxation on each dollar of total income, which could be described as the tax divided by total income. Okay. Let's switch gears a little bit and talk about the second largest group of taxes imposed by the federal government, or employment taxes. Now, employment taxes, or FICA taxes, actually come in two parts. The first is OASDI, which is commonly referred to as Social Security, and Medicare, which is the MHI tax. These are at different rates. So Social Security is taxed at 12.4%, and Medicare is at 2.9%. So uniquely, Social Security is capped at what they call the FICA cap of $132,900 in 2019. And that number changes each year. It's adjusted for inflation. So employment taxes for employees are typically split between the employer and the employee. For example, for Social Security, the employee portion is 6.2%. The employer portion is 6.2%. For Medicare, it's 1.45% for each. Now note, there is a special Affordable Care Act 0.9% Medicare tax on high incomes, and we'll deal with that a bit later. Okay, so if we were to create a 2019 employment tax table, it might look something like this. So Social Security for the employee, 6.2%, for the employer, 6.2%, for a total of 12.4%, and it's capped on wages up to $132,900. For Medicare, it's 1.45% up to $200,000. There's that additional 0.9% Obamacare tax above 200,000. And then the employer's share is 1.45%. And there is no cap on wages for Medicare. So if you make $1 billion, you pay 1.45% on your wages. Okay, note also that the Obamacare share, the 0.9%, only applies to the employee. It does not apply to the employer. All right. So what we're going to do is calculate some employment taxes. And again, you have your tax table. Your table pack has some of this information in it. And the easiest way to calculate employment taxes through these iterations is probably using Excel. So if you'd like, pause the video, open up Excel. I've posted a file in Blackboard that you can use, and you can work along with me. So what we're going to do is pretend that Sandy in 2019 earns $145,000 of taxable wages as a gym manager. And we're going to calculate Sandy's 2019 employment taxes. Then we're going to do it instead assuming Sandy earns $245,000 of wages. And then we're going to do it again and pretend like Sandy's income is much lower. Let's say $14,500. All right, let's go over to Excel. I'll see you there. Okay, here we are in Excel. Let's see if we can calculate Sandy's employment taxes when she makes $145,000. Okay, so we know the rate is 0.62%, and we're going to multiply that by her base. Now recall that for Social Security, there's a FICA cap of 132.9, which means we don't multiply it by her wage base of 145, but instead the 132.9. We do the exact same thing for her employer, and we can see that her total Social Security taxes are $16,479.60. We can do the same thing for Medicare, but note there is no such FICA cap. All of her wages are subject to the Medicare tax. As a result, we can calculate her total Medicare taxes is $20,684.60. Sorry, that's her total tax. Total Medicare is $4,205. As a result, we can calculate her average tax rate as $26,846.60 divided by 145, or 14.27%. Now, what if instead Sandy makes $245,000? And for the purposes of this calculation, we're going to ignore the additional Obamacare tax, but we could throw it in later if we wanted to. Okay, so we'd start with the 6.2%, again, only up to the FICA cap, and calculate her Social Security taxes. Whoa, got a little problem there. There we go. All right, and we can do the same thing with her. Oh, that's the mistake I keep making. Her Medicare taxes, but again, we multiplied by the total wages. There is no cap. All right, now let's say we truly wanted to adjust for the Obamacare adjustment. Now remember, if we look back at your table, you'd identify that it's on wages in excess of $200,000. So what we need to do is add to that his wages, Medicare, his wages that are above the threshold times 0.009. All right. And that would be his total Medicare tax, and his total taxes would be $23,984. You can see that in this case, his tax rate is actually going down. That's a function of the FICA cap, right? So all the income above 132.9 is subject to a 0% rate. Okay, now let's pretend that Sandy's income is only the 14.5. The good news is with 14.5, it's quite simple. The FICA cap doesn't even come into play. And instead, you can just multiply the rates times the base, the wage base, in all instances. A much easier way to do that would just be calculated by 15.3%. So if you're wondering where the 15.3% comes from, think about it as 7.65% plus 7.65%. If you're wondering about the 7.65%, that's simply 6.2% plus 1.45%. All right. All right, let's head back over to our PowerPoint slides. Okay, so that's employment taxes. We got to use a little Excel. I think there's only one thing left to do.